Welcome to this channel. We want to look at IS2 inventories, part 2. In the previous video, I looked at the theoretical framework around the IS2, and I promise that there will be a subsequent video where we look at the calculations aspect of IS2. Okay, if you have not subscribed to this channel, kindly do so right now. This is a channel dedicated to sharing knowledge for students, candidates, and professionals. All right, so we'll be looking at the calculations aspect of the IS2. Like I said in the previous video, valuations of inventories, we are allowed to use first in, first out. FIFO, we are allowed to use the weighted average cost formula. So we want to look at, we'll look at questions where we'll analyze practically how these FIFO and the weighted average cost formula is actually used on the field. Okay, earlier I've talked about net realizable value, and like I said, it's very important that you know how to calculate that for on-field applications and also for your examinations, whichever accounting or audit related exams you are writing. Okay, so we need to be able to look at the current selling cost of that inventory, then deduct costs to completion, especially with a raw material work in progress. Then we also deduct the selling cost, and that will give us the net realizable value. Then we can compare that with the cost, with the historical cost. Whichever one is lower is what we pick as evaluation. Okay, so that we don't overvalue our current asset balance. Okay, illustration: the business produces and sells the following quantities of the products. Okay, so you can see the charts, okay, showing opening inventory on 1st May. Okay, so they have 10 tons, and the valuation was at $40 per ton. That will give us 400. So basically, so we have production, sales, then we have a closing inventory of 12 tons. So the question now is determine the valuation of the closing inventory using FIFO, first in, first out, and the weighted average cost formula. So we know we have 12 items, 12 tons, okay, as closing inventory. Okay, we've had $40 per ton, $45 per ton, we've had $50 per ton, we've had $55 per ton. Which of these prices do we use? Okay, so to value the closing inventory, that is what this question is now asking us. So let's try by trying to approach it from the first question, first in, first out. This is how it plays out. Okay, so opening inventory 10 tons, and we were told the valuation is actually $40 per ton. Then we produce additional 10, all right, making 20 at $45 per ton. Then on 3rd May, we made sales of 7. Okay, we made sales of 7. Now, 7 tons. Since we are using first in, first out, we have a first batch, our opening inventory of 10 tons. We have additional second batch production 10 tons. Now, because we're using first in, first out, these sales would first be taken from the opening inventory, our first batch or our opening batch. So, which means if we are taking the sales of 7 tons from the opening inventory, then that means it's going to be valued at $40 per ton. First in, first out. Okay, Then on 15 May, we did additional production of 15 at $50 per ton. Now, on the 20th May, there was a sale of 20 tons. Now, this is where it now becomes very interesting, where we have to be very careful. So you can see here, I put 20 at the side. Then I broke the 20 into 3 sets. Remember, in this first batch, we had 10 tons, which we have taken 7 out on 3rd May. So which means in this first batch, this opening batch, we have 3 tons left at $40. So those 3 tons is going to be the first set out of these 20 tons. And so it's going to be priced at $40 per ton. And that's what you have here. All right. So we have 17 more. Now, the second batch on 2nd May, we have 10 tons. So that means we can take out the entire 10 tons of the second batch here and value it at $45 per ton. Okay, so 3 plus 10, that's 13. For us to be able to move the 20 tons out of our warehouse or our store house, wherever we are keeping those items. All right, so that means we need 7 more. Those 7 will now be picked or selected from the 3rd batch on 15 May. First in, first out. We have exhausted the first opening batch. We have exhausted the second batch. Now we move to the 3rd batch. So we're going to pick the 7, all right, at $50 per ton. All right, so if you pick 7 here, the remaining 7 to close out the 20 tons. So 15 minus 7. So which means you are going to have 8 tons left for this 3rd batch. Okay, 8 tons, and they are going to be priced at $50 per ton. All right, because that is the batch that is actually left for us. Okay, so that is the batch that is left for us. So these 8 tons now is going to be valued at $50 per ton. So for the total valuation of 50 times 8, of course, that will give us $400. All right, but remember we produce again 24th May, 4 tons again at 55. All right, and that would be 220. So we didn't have any sale again. So which means our closing inventory, first in, first out, is 8 plus 4, which is 12. Then we can add these 2 totals, 400 plus 220, and that will give us 620 as the value of the closing inventory using first in, first out. Beautiful. So let's look at the second question and see how it plays out if we use weighted average costs formula. Now, this is how it is. All right, if we want to use weighted average. Okay, so we have to be very, very careful here. So on 1st May, we have an opening inventory, 10 tons, valued at 40, price $40 per ton. Now, the total is $400. All right, we produce 10 tons more on 2nd May, all right, at $45 per ton. That will give us $450. Now, because we are using weighted average cost formula, we are going to find the total of the units total, all right, which is the total tons is 20, all right, opening inventory 10 tons, production 10 tons. So what we have the total is 20. Then we add the total valuation, all right, 400 plus 450 will give us 950. Now, if you divide 950 by 20, weighted average. So we're going to divide this total here, the total dollar amount, with the total unit amount. Okay, the total item amount. All right, so which is 20. So 950 divided by 20, so we get our weighted average valuation per unit, which is now $47.5. So which means now any sale that we make, all right, for now, okay, the since we are using weighted average costs, okay, so this is going to be the unit price, okay, because we are actually combining all the batches together. Then we are using a single formula instead of what we did before, first in, first out. So more or less like we're using this average price we're using. All right, so this is now our new average price. Then we make a sale of 7 units, which means our remaining closing inventory on 3rd May will be 13. 20 minus 7 will be 13. All right, the average inventory price as at that 3rd May is still 47.5. As long as you have not added another batch into your warehouse. Okay, so every time there is a new production item added to the warehouse, then you have to recalculate the weighted average or the average price again. All right, the average cost. So the inventory is now remaining 13 at this 47.5. 47.5 times 13. All right, so the total inventory valuation as at 3rd May is $617.5. All right, incidentally, on 15 May, we produce again 15 tons at $50 per ton. All right, now 50. So we have a closing inventory or an opening inventory, a new opening inventory at 617.5. We have additional inventory 50.15 that is giving us 750. So we add, since we have another batch again, we have to recalculate and get another average price. Okay, so that is 750 plus 617.5. Our new total inventory valuation is 137.5. But if we add the total inventory, the opening inventory plus production, this is 28. So you divide 137.5 by 28. You can try that with your calculator. What you will get as the new average unit price is now $48.84. So on 20th May, we made a sale of 20 tons again. So our closing balance, new closing balance is 8 tons. All right, remember our new average price, average cost is now 48.84. So we can value this 8 tons multiplied by 48.84 to give us 390.70. You can try that with your calculator. Okay, you can try that with your calculator. Then we have production. Okay, we produce again on 24 May. Remember I said at every production that is added to the inventory, you have to recalculate again. All right, so we produce 4 additional tons at $55 per ton. So 55.4, okay, will give us 220. So we add the new total together. 8 at 48.84 will give us 390.7. All right, 4 at $55 will give us 220. If you add the new totals together, you have $610.7. Add the total tons there, you have 12. So 610.7, all right, divided by 12, that will give us the new average cost. So weighted average cost will be 50.89. So actually our closing balance here, closing inventory is valued at $610.7. Why we're using first in, first out? If you have noticed, you will have noticed that our valuation using closing inventory valuation using first in, first out is slightly higher, right? It is at 620, right? But using a weighted average, right, the closing inventory is at 610.7. So weighted average, just like the name is basically like smoothing out the valuation over the period that we are under consideration. So this is weighted average cost formula and the first in, first out. These are to do it in case you are writing an examination or you are inventory officer or manager for your organization. Okay, let's look again at another calculation of net realizable value. Manufacturing cost for Alabama PLC in 2018 for inventory held at the year end are $8 million. All goods held at December 31, 2018 were sold in January 2019 for $6 million. All right, so you can see actually the cost was $8 million as at December, but when they were selling them in January, they were selling them for $6 million, which actually means, all right, there has been a drop, all right? Maybe there was obsolescence. So definitely the valuation of that inventory had dropped, okay? The selling costs incurred for the goods sold in January 2019 were $2 million. So determine the valuation of the inventory as at December 2018. So the cost is $8 million. Then we have to calculate the net realizable value, okay? So the selling price, all right, was $6 million. They sold the inventories for $6 million. But remember that there was also selling costs of $2 million. So this time around, there is no cost to completion. So we can ignore that. So the net realizable value is going to be $6 million minus $2 million. So that will give us $4 million. So the net realizable value of $4 million is less than the cost of $8 million. So which means for us to be following the requirements of IAS 2. That means the valuation of inventory as at 31 December 2018 should be $4 million. We have to go for the lower of the cost and net realizable value, which is $4 million in this case study. Okay, let's look at another calculation. Kenny's business sells 3 products, A, B, and C. Given the following information at the end of the year, at the year end, what is the value of the closing inventory? So we have the products A, B, and C with cost and net realizable value and units. Remember, we said always, when you compare cost and net realizable value, always go for the lower. For example, A now, we have to pick $10,000 because it's lower than the net realizable value when we are valuing product A. All right, when we are valuing product B, we have to pick 11,000 because the NRV, because this time around is lower than the cost. All right, when we are valuing product C, we have to pick 16,000. All right, because the NRV is lower than the cost. So that is how we actually implement IAS 2 in this case study. So look at the answer now. So A is 10,000. So we pick 10,000 as the monetary valuation multiplied by the number of units. So that will give us $1 million. All right, then we'll pick 11,000 NRV because the NRV is lower than cost in this case. All right, so multiply by the number of units, so you get 2.2 million. Then for the third product C, we pick 16,000, which is the NRV because it's lower than the cost. All right, so 16,000 times 300 units this time around, get 4.8. So we can add the valuation of A, B, and C together, and that will give you 8 million. So this is how it works out. Always calculate your NRV, net realizable value, and compare it with the cost of the net book value of the current asset of the inventory. Then whichever one is lower is what we are going to pay. Okay. General disclosures. In IAS 2, the financial statement shall disclose accounting policies adopted in measuring inventories, including the cost formula used. You know, we said that you have options. You can use first in, first out. You can use weighted average. So you have to disclose whichever method you have, whichever formula you have adopted. B, the total carrying amount of inventories and the carrying amount in classifications appropriate to the entity. All right, the carrying amount of inventories carried at fair value less cost to sell. The amount of inventories recognized as an expense during the period. The amount of any write-down of inventories recognized as an expense in the period in accordance with paragraph 34. The amount of any reversal of any write-down that is recognized as a reduction in the amount of inventories recognized as expense in the period in accordance with paragraph 34. Then the circumstances or events that led to the reversal of a write-down of inventories in accordance with paragraph 34. Then the carrying amount of inventories pledged as security for liability. So let us know if they are lien on any of your inventory. So give us a true, transparent picture of what is happening as regards inventory. So that is basically what the disclosure is all about. So this is the end of this series on the IES2. I will still be continuing with other videos on international financial reporting standards. My name is Akinwale Akindia. So try and subscribe to this channel so that you can get more accounting, auditing, and educational videos from this channel. Thank you.